When a corporation needs to raise millions of dollars, they typically face a binary choice between two opposing paths: issuing debt or issuing equity. If they choose debt, like selling corporate bonds, they get the cash without giving up ownership. But that money comes with a strict repayment schedule. Miss a single payment, and the company faces total bankruptcy. If they choose equity by selling common stock, there is no mandatory repayment hanging over their heads. However, they must surrender voting control and permanently share future profits with a new pool of owners. Take the CIMB Group, a major Malaysian bank. They recently needed to raise 500 million ringgit to boost their Tier 1 capital reserves, but they refused to dilute the voting power of their existing owners. Traditional bonds carried too much strict repayment risk for a banking capital cushion, and common stock meant losing control. Neither standard option could solve the need to raise massive amounts of cash while protecting the current ownership structure. The solution is a financial chimera engineered to bridge that gap: preferred stock. Issuers treat it as a modular instrument, allowing companies to dial in exact levels of risk, control, and payout depending on the market environment. If we map this out on a spectrum, traditional bonds anchor the extreme left, and common stock anchors the extreme right. Preferred stock drops exactly in the center, pulling traits from both ends. Mastering the mechanics of this specific hybrid reveals how modern corporations balance the immediate need for cash against the long-term necessity of corporate control. Preferred stock has features that pull it toward the debt side of the spectrum. First, it pays a fixed dividend, usually expressed as a percentage on its par value. Second, if the company goes bankrupt, preferred shareholders are paid out before any common stockholders. Because it acts like a bond but usually has no maturity date, we value standard preferred stock as a perpetuity, an infinite stream of payments. This equation shows the perpetuity model in action. V is the intrinsic value of the stock. To find it, you divide D, the fixed annual dividend, by R, the investor's required rate of return. On the equity side of the spectrum, buying these shares means you legally own a piece of the company. However, the asset systematically strips away voting rights from the investor. To protect investors who have no say in company decisions, many of these shares are cumulative. If the company misses a dividend, those payments pile up and must be cleared before common shareholders receive anything. This baseline configuration creates a predictable income stream for institutional investors, allowing the issuing company to raise cash without shifting its internal power structure. Modern finance rarely sticks to that base model. Issuers frequently add specific features, or mutators, to fit different economic environments. This chart maps out how we categorize these variations. On the right side, we see equity-like mutators, convertible and participating preferred stock. These features offer higher flexibility and potential upside for the investor. Conversely, callable features limit the upside. Take the 2021 Petronas issue with a 6.25% dividend. Even if market rates fall and the baseline math says the stock should be worth $125, the value hits a hard ceiling at $105 because Petronas can buy the shares back at that price. This cap provides a financial escape hatch. If market interest rates drop, the company can call the shares back at the capped price and refinance their capital at a lower rate. In contrast, the convertible mutator used in venture capital gives the investor the right to trade their fixed preferred shares for common shares if the startup's valuation explodes. This adds what we call option value to the baseline perpetuity math. It combines the downside protection of debt with the unlimited potential upside of equity if the company succeeds. These mutators turn a rigid mathematical tool into a mechanism capable of solving both conservative liquidity needs and high-risk venture funding requirements. Capital structures aren't just a choice between stocks and bonds. They exist on a customizable spectrum of risk and reward. This hybrid asset acts as a shock absorber during market volatility. It allows commercial banks to maintain regulatory stability and shore up reserves during crises, while still yielding high returns for institutional investors. When tweaked with different clauses, that same asset class empowers venture capitalists to fund early-stage tech startups that lack the stable cash flows required for traditional loans. Ultimately, the mechanics of preferred stock show that the most effective financial tools aren't found at the poles of risk or safety, but in the specific engineering of the space between them.